Well, a fellow who watches central banks very closely is American Jim Rickards, the Cassandra of Wall Street, with a big following, is on a visit to Australia. I caught up with Jim Rickards earlier in the week and asked him for his take on Donald Trump's demands that Jay Powell at the Fed drop rates by a full 1% in short order and bring back quantitative easing.
Well, the Fed is not going to cut 1% at one time now. They'll do these 25 basis point increments that we've seen before. So I think at this point, September, we can say they will cut 25 basis points. It's never a sure thing, but that's a very high probability, kind of 90%. And then probably too soon to forecast December, but they might cut again in December. So they meet 8 times a year. So over the course of 6 months, 4 meetings, they might cut 1%. So,
but doesn't this add pressure to the Federal Reserve when you've got the Commander-in-Chief saying we want a 1% cut in interest rates in short order?
Well, it certainly adds pressure, and it's highly unusual. Presidents usually, they might have lunch, privately with the chairman, but they don't say anything publicly. But Trump's not a usual president. You have to go back pretty far in U.S. history to find anyone like him, maybe Teddy Roosevelt or Andrew Jackson. But the point is, yeah, he's putting pressure on the Fed, but at the same time, the Fed has its independence, will maintain its independence. But recall last December, December 2018, the Fed raised rates. That was a mistake. Everyone now agrees, including the Fed. They came out, we had what we call the Christmas Eve massacre, where stocks fell. They had fallen over 11% from October 1st to Christmas Eve. So Jay Powell did an about-face. He said, we're not going to raise interest rates for the foreseeable future. We'll tell you if we are, but as of now, we're not. And then by the spring, he said, well, we're actually going to cut rates. And July 31st, they did cut rates. So that's tantamount to admitting they made a mistake. So the president was right. And even though the Fed doesn't say it in so many words, they're going to cut again in September. So the president's kind of, when you're hunting, you lead the target. You don't aim at the target, you lead it. Trump is leading the Fed to where they probably have to go.
You had some insights recently, I think, at the Bretton Woods 75th anniversary that really set up monetary policy and currency in the Western world, and to some central bankers as to where they thought rates were going. We
were up there with a group, Larry Summers, former Secretary of the Treasury, Peter Thiel, co-founder of PayPal, Ben Steele from the Council on Foreign Relations, pretty high-level group, talking about the future of the international monetary system. So one of the panels I joined, it was off the record, so I can't tell you the names of the individuals or exact quotes, but suffice to say there was a senior official from a regional Federal Reserve Bank, senior official Board of Governors of the Fed, and a governor of the ECB. So these were the real, European Central Bank. So these were the real deal, top central bankers. And I was surprised at how relaxed they were about the fact that interest rates have to come down. This is the easiest forecasting I've ever done, because they told us interest rates are coming down. They made a really crisp distinction, which you rarely hear, between nominal rates and real rates. Because I know so many people have lost a fortune in bonds. They go, well, rates are at an all-time low. It's a bubble. You got to short the bonds, including Jeff Gundlach and some very famous investors. But they missed the point that nominal rates are low, but real rates are not low. Inflation is a little bit below the nominal rate, which means that the real rates are positive. So how do you get negative real rates? Real rates are what affect investment and the price of gold and a lot of other housing and a lot of other variables. Well, how do you get a negative real rate? Well, you have to get nominal rates below the rate of inflation, but inflation is coming down. So it's like a cat chasing its tail. So inflation is coming down. They're cutting rates, but they got to cut them a lot more to get a negative spread. And that's what they're doing. They said, yeah, we have to cut rates a lot. So you can just sit here and forecast lower rates.
So were they open to the idea of negative rates?
They didn't say we're going to negative rates. No policy decision had been taken. But they said, yeah, when we get to zero, we got to look at negative rates. So rates are coming down, simple as that.
Right, so we now got this inverted yield curve with US Treasuries. A lot of people are talking about. Now, you're saying that this isn't going to guarantee recession. Is that right? Because, it would seem to me that the bond market would be looking more at sovereign risk elsewhere than in the US.
I think that's correct. Inverted yield curve does traditionally signal a recession, but a couple of very important caveats. Number one, the lead time is 18 to 24 months. So it doesn't mean you have a recession. If you listen to the Democratic presidential candidates, you would think we were in a recession already. Well, no, even if we are heading that way, it's at least a year, certainly past or likely past the election, so it won't affect Trump's re-election chances, number one. Number two, this is a very unusual yield curve inversion. Typically, the way it works is the economy is too strong, inflation is too hot, the Fed has to raise rates to snuff out inflation, so short-term rates go up. Meanwhile, the bond market is saying, well, yeah, but if you do that, you're going to cause a recession, So we'll take 10-year paper and 30-year paper at a lower yield. So short rates are higher than long rates because the Fed's trying to snuff out inflation here, but they're going to cause a recession over here. That all makes sense. That's not the case today. We don't have inflation.
Right. So on top of all this, we've got this huge trade war, and it would appear a currency war with China responding and the yuan going through that 1 for 7 threshold with the US dollar.
Well, I'm sure you recall my first book, Currency Wars, which came out in 2011. I said a couple things. Number one, the sequence is currency wars, trade wars, shooting wars. Hopefully that won't play out this time. And I also said that we're not always in a currency war, but when we are, they can last 15 or 20 years. So first of all, I'm not surprised. Here we are in 2019, 9 years after the currency war started, we're still in a currency war. That comes as no surprise. And then the trade war sort of arrived right on schedule in January 2018 when Trump decided to fight back against the Chinese. So this historic sequence, which we saw in the 1920s and 1930s, is playing out.
So where's this going?
It's going to get worse. And as a sort of touchstone or map for that, viewers might be interested in a speech that Mike Pence, our vice president, gave in October 2018. It's available on the White House website, very easy to find. But what he did, he took the currency wars and the trade wars and put it in a much broader context. Theft of intellectual property, violation of human rights, confrontation in the South China Sea, efforts to make themselves a regional hegemon, et cetera. And it's been labeled Cold War II, or the Pence Doctrine. It's the only case I can think of where Trump didn't name something after himself. He let Mike Pence name it. But it's called the Pence Doctrine. And it's a 10-page speech, but you have to read that to put these trade and currency wars in a larger context. And that's the problem with a lot of financial analysts and people on Wall Street and Sydney financial community, et cetera. They focus on the narrow and they miss the broader context.
You're out here having written another book, Aftermath, which I guess is all about surviving in these sorts of conditions.
Right.
Where do investors go now with the stock market, particularly with this relatively new trend of huge rise in passive investments and ETFs?
Right. Well, the passive investment is one of the chapters in my book, and I make the point that my metaphor is if a mosquito lands on the back of an elephant, the mosquito gets a good meal and the elephant doesn't notice. But if 1 million mosquitoes descend on the elephant dies. And that's a metaphor for the difference between passive investing and active investing. Now, when passive investing first came along in the 1970s, Jack Bogle, Vanguard, index funds, and so forth, the active investors ruled the day, and then passive investors were hitching a ride like a mosquito on an elephant at low cost, just saying, hey, 20 years, 30 years, the market will do fine. But the problem is that the assets allocated to passive investing are now like 1 million mosquitoes, and the active investors are drying up. There are very few.
So you don't agree with someone like ETF guru Graham Tuckwell, who says you actually don't need a lot of active stock pickets?
I don't agree at all, and here's why. When stocks go down, what happens? Investors in passive funds, they get nervous. They want their cash. So they call up, they say, sell my stocks, give me the cash. So the passive funds become sellers. They have to. Who's the buyer? These things are going to go no bid. If you have no active investors, no capital committers, no market makers, they go no bid and it'll sink like a stone. That's the danger. Hasn't happened yet, but that's another kind of landmine waiting on the landscape.
Finally, Jim, where in all of this do you see gold? Because you are a gold bug.
Well, it's funny. I'm in Sydney for the ABC Bullion Conference, so that's very much a focus for the moment. Look, this is going to sound like an overstatement. I don't mean it to be, but everything I look at says gold prices are going higher, and here's why. Supply is flat, about 4,500 tons for 6 years. Demand is increasing. Central banks have gone from net sellers to net buyers, so just normal supply and demand would push it up. Geopolitical concerns, that's another reason. Well, look around. We're near war with Iran, sanctions on China, North Korea, Syria, Venezuela, who's next? But the key driver right now are negative real rates, because gold, if you think of it as money, and I do, competes with treasury bills and other forms of other money substitutes. Well, when the yield is high, who wants gold? But when the yield goes zero or negative, all of a sudden gold looks very attractive. Well, based on what I encountered at Bretton Woods, the central banks told us rates are going to zero or negative. So that means gold goes higher.
Jim Rickards, I wish we had longer. Great to talk. Thank you.
Thanks.